Most auto dealership owners and managers think of payment processing as a cost center, and with good reason. So, before we show you how it can become a profit center, let's take a look at why it costs so much. The story begins with MasterCard and Visa, who have charged hefty fees for their services right from the start. So much so that in 1996, Walmart and other merchants sued them, claiming that they controlled the credit card processing market and that they drove up fees in violation of antitrust laws. No trial was set until 2003. Days before appearing in court, MasterCard reached an out-of-court settlement, and 2 days later, Visa did too. Both companies agreed to reduce their fees and to pay billions in damages. Problem solved? Not quite. In 2006, MasterCard went public, and in 2008, Visa did too, with its stock surging 28% in what was at that time the biggest IPO ever. Since then, each company's stock has performed extremely well. One reason may be that after they went public, they made their merchants pay more and more in interchange fees, as you can see in this chart from the Government Accounting Office's 2009 report on the topic. Merchants today pay up to 4% of the value of a transaction just to process it on a credit card. Because of this, in 2012, Walmart, among others, dropped out of the multi-billion-dollar out-of-court settlement so it could sue Visa on its own, claiming it suffered, quote, enormous damage, end quote, because of Visa's pricing practices. Then, around the same time, in 2011, Google disrupted the whole payments industry with the Google Wallet. The wallet contains your existing credit cards. Theoretically, you want it because it lets you wave your phone next to a receiver to pay, as opposed to swiping plastic. Google didn't charge for the service, believing, as it always has, that the data it would collect from people using it would be far more valuable than a fee. They were probably right, because when they announced that they wouldn't share their data, Visa and MasterCard hiked up their fees to merchants accepting the wallet. As soon as Verizon, AT&T, and T-Mobile saw Google Wallet, they refused to sell Android phones containing it. Why? So they can make their own digital wallet, of course. It came to be known as SoftCard. Meanwhile, another company, Paydiant, invented its own mobile wallet in a quixotic but partially successful attempt to compete with Google. And in 2012, Walmart and 8 other heavy hitters, including Target, Best Buy, and ExxonMobil, made their biggest move to date. They founded the Merchant Customer Exchange. It's designed to compete directly with Visa and MasterCard, and it will make its public debut over the course of 2015. Needless to say, they also made their own digital wallet, called Currency. When you pay, it displays a unique QRC code that can be read by the scanners commonly owned by merchants. But a lot of merchants have moved beyond countertops cluttered with devices already. In 2010, Square came out with a free credit card reader you could plug into your phone or tablet. Anyone, including people with no employer identification number or merchant account, can use it to deposit credit card payments into a checking account for a 2.75% fee. PayPal leaped into that market and introduced a competing service with a triangular device, and they charge 5 basis points less per transaction. Then Apple made its move. In 2014, it released Apple Pay when it released its wildly popular iPhone 6. True, it's another wallet, but this one uniquely incorporates a separate chip to vastly improve security. You use it almost the same way you use the Google Wallet, which means the merchant must own a near-field communications receiver. Next, as if to steal Google and Apple's thunder just for fun, Loop Pay came out of nowhere with a phone case that could release a magnetic pulse which would trick any old-fashioned card-swiping device into thinking that a card had been swiped. Suddenly, all the existing equipment in the country became a mobile phone payments platform. And yes, they made yet another digital wallet. Then, the acquisitions began. To make peace with the phone companies, Google bought their SoftCard wallet and stuffed it into Google Wallet. PayPal, which will be spun off eBay this year, bought Paydiant, so it can be at both the merchant's point of sale and in the customer's phone. And if there aren't enough names for you to keep track of in all of this, here's a new one: Samsung. The massive Korean phone maker bought LoopPay, possibly to integrate its magnetic pulse technology. It's important to remember that while all of this was going on, major corporations from Home Depot to JP Morgan lost hundreds of millions of credit card numbers to hackers. Visa and MasterCard shouldered the losses and then figured out what to do next. Their solution? Make every merchant in the country buy another card reader, only this time with chip and pin technology, or actually half of it, built in. Used globally for nearly a decade, the chip and pin international standard requires customers to insert their card into a machine and to enter a pin along with it. But, somewhat bizarrely, given the profusion of technology in the payment space, Visa and MasterCard decided against using the international standard in the United States. Concluding that Americans don't want to remember a PIN number, they're going with the less secure chip and signature method. You better comply too, because if you don't, as of October this year, you'll be liable for fraudulent credit card purchases. And whatever you do, don't compare us to Europe. Over there, everyone has a chip and PIN card, vastly reducing fraud, and merchants pay Visa and MasterCard less than 1% of each transaction for the exact same service they provide here. No wonder you think of payments as a cost center. Hopefully all this competition will soon stabilize into a price war that will work in your favor. But you might not write that into this year's financial forecast, even though there's one way you could. The 2010 Dodd-Frank Wall Street Reform and Consumer Protection Act lets you charge Visa and MasterCard's fees separately. You've probably seen some gas stations that have different prices depending on how you pay, and this law is the reason they can do that. You can too. If every business did, letting their customer know just how much of their payment goes to the payment processor, one can imagine that the competitive landscape would look a lot different. If they had to pay for it themselves, customers would probably select the least expensive payment method. But hardly any merchants take advantage of the law, which means that the interchange fee is literally built into the price of everything we buy. That's not likely to change anytime soon. And for a lot of merchants, these fees are one of their biggest expenses, right up there with rent. So how could anyone think of payments as a profit center? In one way, merchants already do. They feel that accepting credit cards as seamlessly as possible enables them to close sales. That's a profit analysis of sorts. But perhaps we can do better than that. Let's say you have a customer who can pay full price for a $15,000 used car, and you give him two options. He can use his credit card and pay the 4% fee, $600, on top the purchase price, or he can write a check for no additional fee because processing a check will cost less than half a point. What's he going to do? Obviously, he'll write a check. How about the service department? Let's say you have a customer who can't afford an essential $1,200 repair. He needs a solution, but now you offer three options. The first one is to use a credit card and to pay the $48 fee on top, plus interest on the debt until it's paid. The second one is to open a new credit card, such as one from GE Capital. This has been a go-to method for a lot of dealerships because it often helps people afford repairs they can't cover today. But it's still a credit card, so your customer has to pass a credit check, a difficult proposition for a lot of people recovering from the recession. For argument's sake, let's say they pass. So you charge the $48 on top, and the customer pays that as well as interest on the debt that can quickly escalate to 20% or more. Most people who go that route do so because they have no choice. So they get out of it quickly. The majority of people who end up with one of these cars pays it off as fast as they can. In fact, 60% of them have an outstanding balance of zero. What if you could compete directly with that type of financing, but you could offer it for free? And what if you could do this and be certain that you would receive the revenue, same as when you accept a credit card? Would you close more service department deals? Would you close more used car sales? Of course you would. Now we're talking about profit, and this brings us to your third option. You can allow your customer to write a series of checks for free, without financing, without a credit check, so they can pay for the repair over time. And what if you did this knowing that the revenue from each of those checks is guaranteed to fall to your bottom line, same as a credit card? You can have this option today. We call it multiple check, and you might know it as hold check. It's bundled into the payment processing solution we designed specifically for car dealerships, cars. Closing more sales and getting guaranteed revenue changes payment processing into a profit center. In fact, several of our clients have seen as much as a 40% increase in their service department revenue because they offer it. Sometimes you don't need elaborate technology to increase your sales and profits. Instead, you can use one of the oldest, most common, and most secure payment methods in the world to please your customer, to close a deal, and to add guaranteed revenue to your balance sheet. There's another benefit as well. Our CARS package includes remote deposit capture, which allows you to deposit checks right from your F&I office or the service department. Dealing with paper checks and the elaborate and time-consuming process of recording them, driving them to the bank, and then waiting for a merchant teller to take them can cost you thousands of dollars a year in wasted time and fuel. With remote deposit capture, you scan them and deposit them in moments, saving time and money and accelerating your cash flow. We're proud to be an American company that's been serving auto dealerships for over 30 years. And we're ready to help you profit from your payments. We look forward to talking to you.